Hello and welcome to Mint Funds Update. My name is Marek Krzeczkowski and I'm joined by Ryan Falls. Today we will talk about the markets and what happened within our funds last month. Currently, the big concern among investors is whether the US is in the recession. One of the indicators that is often used is so-called SUM rule, which is a change in unemployment rate. That rule says that if unemployment rate increases by more than 0.5% from the last 12-month low, the recession is almost certain. And here you can see the chart, which shows the history of this indicator going back to 1960. And as you can see, the red dots indicate points where unemployment increased by more than 0.5%. However, what's really important is to highlight that even though unemployment in the US has hit 4.3%, we still believe that soft landing is the scenario that is most likely here. Why? Because if you look at other activity indicators, they remain healthy. And this resembles previous SUM rules false signals rather than a recession. Now, the key question is, why has unemployment risen by 0.5%? And I think what's really important is just to highlight what's driving that dynamic. So the strong labor supply was the reason why it has passed the threshold. And half of that increase can be explained by unemployment entrants entering the labor force. So on one hand, we have a higher participation. So following the COVID pandemic, we had increase in participation in labor. But also we had a surge of migration. And we are currently looking at a very high immigration numbers in the US and globally. But in the US, that is a big factor that is driving the increase in unemployment. Last but not least is the just observation that following that SUM rule being triggered and a few market commentators expecting recession on the back of it, and markets have repriced interest rate expectations. So bond yields have come down. And as a result, some interesting things happened within equity markets. So rate sensitive sectors went up. So real estate, utilities, and financials, as you can see here on the left-hand side. On the other hand, growth stocks that are sensitive to the recession scare have seen a poor performance since June 2024.
Cool. And then within New Zealand, we had the RBNZ meeting also happening in August, where they followed through the 25 basis points cut to the official cash rate. This actually followed on from their dovish hold in July. So if we look here at the left-hand chart, we have the projections as released by RBNZ in their August MPS statement. So this effectively shows where the RBNZ thinks or sees the OCR over the next few years. So the light green line is where they see it in August versus the black line, what they've seen in May. So as you can see, quite a large drop with 130 basis points extra by September 25 in terms of cuts. So quite a big change and quite a substantial change. And if we look at the right-hand side, we can see what RBNZ's projections are for the headline CPI number. And whilst they haven't moved as dramatically as the OCR chart, you can still see that RBNZ sees the CPI number coming back into the target range, so between 1% and 3%. This is by Q3 this year. We'll now move on to talk about the diversified funds performance. I'm going to start off the diversified income fund. So the asset class performance was positive in August, so the fund returned plus 1.1%. And this was in the back of global equities reversing their wobble at the start of the month, and domestic rates continued to drop after the RBNZ cut the cash rate, as we just discussed. So fixed income was the largest positive contribution of plus 0.6%, with global equities coming in second, plus 0.3%, and Australasian equities also with plus 0.3% for August. Turning to the positive contributors, so yeah, fixed income performed robustly as rates fell after the RBNZ cut the OCR by 25 basis points, and our long duration position continued to help bolster returns as yields fell. We also note that we took some profits on short end curve trades on the back of these moves and the rest of the momentum of rates after the cut. Within global equities, Boston Scientific was up 10.7%, and that was our top contributor. They announced they received the CE mark for their aortic valve system product, which is a mark of compliance with the EU health and safety standards for their products. Within Australasian equities, we had Fisher & Paykel Healthcare was up 10.1%, and Charter Hall Group was up 14.3%, and they were the two standout names. With the latter, Charter Hall reported higher than expected future earnings for 2025. Turning to the negative contributors, so starting with global equities, Martin Marietta Materials was down 10%, and that was the main detractor for August. This is driven by the back of disappointing set of quarterly results with earnings and revenue declining and lower guidance for the financial year 2024. Management attributed this to poor weather in Texas, which is one of their key markets, and continuing restrictive monetary policy in the US affecting construction. Within domestic equities, Megaport was down 22.2%, and this fell on the back of weaker than expected guidance for 2025, and this was despite restructuring earlier this year. This is also against a backdrop of negative sentiment within the wider information technology sector, as the AI rally faltered globally at the beginning of August. Turning now to the growth fund, and asset class performance was also positive in August for the growth fund, and it's up plus 1.9%. And again, this is on the back of global equities reversing their wobble from the start of the month. So global equities was up 1.7%, and that was our top contributor in terms of asset classes, with Australasian equities contributing plus 0.1% and fixed income also plus 0.1%. Turning to the positive contributors, within global equities, Eli Lilly was up 19.4%, and Boston Scientific again was up 10.7%. They were the top two global equity performers for the growth fund. Eli Lilly announced Q2 earnings over the month, which beat analyst expectations, and this is in part due to the success of their weight loss medication, Mounjaro. Within Australasian equities, we had Fisher & Paykel Healthcare again, plus 10.1%, and Stride Property, plus 14.1%. They're the top two performers. Fisher & Paykel provided a very strong trading update, which showed an increase in future earnings levels, with the market reacted quite positively to. And then again, we had fixed income performing robustly as rates fell. The Orbian said cut the OCR. And again, our long duration positioning within the growth fund also helped continue to bolster returns as those interest rates come down. Negative contributors then, again, within global equity, we had Martin Marietta Materials. Again, this is driven by the disappointing set of quarterly results. And then also within domestic equities, again, we had Megaport was down 22.2%, and that was on the back of that weaker than expected guidance for 2025, despite that restructuring earlier in the year.
Thank you for listening. If you have any questions, please contact us at info@mintasset.co.nz.